Good day, everyone. Today, we're presenting our analysis on the implications of President Donald Trump's 2025 reciprocal tariff policy and how it relates to the role of the US dollar as the world's primary reserve currency. This event, now famously referred to as Liberation Day, has triggered one of the most significant financial market responses in recent history, revealing a deep-rooted tensions in the international economic order. Now, the shock of April 2nd, the market meltdown. On April 2nd, 2025, President Trump announced sweeping tariffs on nearly every US trading partner, regardless of their economic relationship status. This was an unprecedented move. It applied even to America's closest allies and partners under long-standing free trade agreements. The global reaction was instant and brutal. The Dow Jones Industrial Average plummeted by 4,000 points in just 2 days, the worst back-to-back drop ever, including two single-day losses of over 1,500 points. Japan's Nikkei index fell by almost 8%, prompting an emergency trading halt. Canada's TSX dropped by nearly 5% in one day. In Australia, close to 70 billion Australian dollar was wiped off the stock market in a single week. These were not just market corrections, they were symptoms of a sudden loss of investor confidence in the global trading system as we know it. Faced with this collapse, the White House announced a 90-day pause on the tariffs, except for those targeting China. On April 9, markets partially rebounded, but the underlying uncertainty remained.
To fully understand what's at stake, we must go back to the foundations of global trade and monetary policy. After World War I, the United States led the creation of a new economic order. The 1944 Bretton Woods Conference established the World Bank and the International Monetary Fund, alongside the General Agreement on Tariffs and Trade, GATT, which later became the World Trade Organization. The US dollar became the anchor of this system, fixed to gold, and other currencies were pegged to the dollar. This made the USD the world's reserve currency, trusted for global trade and investment. But in 1971, under President Nixon, the US abandoned the gold standard in what's now known as the Nixon shock. The dollar became a fiat currency, its value no longer tied to the gold, but to the global confidence in the US economy and institutions. This bond shift gave the US enormous flexibility in fiscal and monetary policy. It has also enabled the US to finance its debt through what economists call seigniorage, the profit a country earns by issuing currency that others must hold to trade globally. Since then, America has been able to run massive deficits without suffering the same consequences as other nations. Now, the power and limits of the dollar. This privilege has come at a cost. As of 2025, the US national debt stands at 36.2 trillion, and this year's budget deficit is projected at 1.9 trillion, according to Congressional Budget Office. No other country could run these deficits without triggering a currency crisis. The US gets away with it because the dollar is still seen as indispensable. But is this still sustainable? That's what Trump's policy forces us to examine the rationale behind these tariffs. It's not simply to punish trading partners, it's an attempt to monetize America's privileged position. The administration hopes to generate revenues through tariffs, reduce trade deficits, and ultimately slow the growth of national debt. It's a bold move that assumes the rest of the world will continue to use the US dollar, no matter how disruptive US policy becomes. Now I'll be handing over to Liam.
Thank you, Karim, for handing over. Hi, I'm Liam, and I'll be covering the next three slides. This is the immediate market fallout and short-term calm. So, the global economic response to the tariffs was immediate and severe. Within days, major indices plunged, reflecting investor panic and widespread uncertainty. However, sentiment shifted on April 9th when a 90-day pause was announced. The S&P 500 rebounded by 3.8%, and the CBOE Volatility Index, VIX, which had spiked above 60, fell sharply to 18.22, signaling a return to relative calm. JP Morgan responded by lowering its recession forecast for 2025 to below 50%, citing the pause as a key stabilizing factor. Despite this short-term relief, markets remain tense. Tariffs on China are still in place, and the temporary nature of the reprieve means uncertainty lingers. Investors are cautious, aware that the full implementation of the policy could return abruptly, reigniting market volatility and economic disruption. Now, this is the risk to the global order and the USD status. But first, what happens if this policy resumes in full force after 90 days? The consequences could be profound. A full return to Trump's reciprocal tariff regime may trigger widespread retaliation from trading partners, leading to a slowdown in global trade and fragmentation of key supply chains. Export-reliant economies, particularly in emerging markets, would face reduced demand and heightened financial instability. Beyond trade, the broader threat lies in the undermining confidence in the US dollar. Central banks may accelerate their shift away from dollar-denominated reserves, a trend already in motion. According to Wolf of Wall Street and IMF data, the share of USD in global reserves has declined steadily over the past decade. Many nations are diversifying into gold, the euro, and the Chinese yuan to hedge against US political and economic unpredictability. If the US continues using tariffs to assert economic dominance, it risks being seen as an unreliable steward of the global monetary system. This could raise US borrowing costs, reduce demand for treasuries, and weaken the dollar's long-held reserve status. While no single currency is poised to replace the dollar overnight, sustained de-dollarization would mark a historic shift in the global financial order, with long-term consequences for American power and economic stability. Now, this slide details the experts' perspectives. Experts have not held back their criticism. Greek economist Yanis Varoufakis compared Trump's tariffs to the Nixon shock, arguing that it represents another US attempt to change the rules in its favor when the current system no longer works to its advantage. Columbia University professor Jeffrey Sachs was even more scathing. Speaking at the Antalya Diplomacy Forum in April 2025, he labeled Trump's trade strategy childish and dangerous, warning it would erase $10 trillion in global wealth and shatter trust in the USD as the world's monetary foundation. These warnings should not be ignored. They reflect a broader concern that the US is abandoning the very leadership role it once embraced. Now I'm going to pass on to Noah, who will explain the rest.
So, what might unfold during this 90-day pause? Diplomatic negotiations will intensify. Allies like the EU, Canada, and Japan may lobby for exemptions or concessions, aiming to protect their industries while maintaining cooperation with the US. Behind closed doors, trade envoys will assess leverage and domestic industries will brace for the outcome. Meanwhile, China, facing tariffs without a pause, could retaliate with countermeasures. These might include reducing US Treasury purchases, restricting rare earth exports, or accelerating its push for the digital yuan to challenge the dollar-based settlements. Such moves would signal a broader effort to erode US financial influence. If tariffs return across the board, the potential for global trade wars will rise sharply. The risk of coordinated resistance to US economic dominance could increase, with countries forming alternative alliances and trade blocs to protect their interests. In time, we may witness the rise of a multi-currency trade system, one where the US dollar is no longer the default, but just one of several competing options. What unfolds in these 90 days could determine whether the US reinforces its global leadership or accelerates the shift to a new economic order. Now we confront a central question. Can tariffs eliminate the US national debt? In short, no. Tariffs may generate short-term revenue, but they are unlikely to make a meaningful dent in a $36 trillion debt without triggering serious economic side effects. While tariffs can increase government income temporarily, they also raise costs for customers, reduce the global competitiveness of US businesses, and often provoke retaliation trade barriers from other nations. If global trade contracts in response, so too does the global GDP, including that of the United States. Slower growth means lower tax revenue and weaker investment, undermining the very goal of fiscal improvement. There is historical precedent here. In the 1930s, the US enacted the Smoot-Hawley Tariff Act to protect domestic industries. Instead, it sparked a chain reaction of global retaliation, collapsed world trade by 2/3, and deepened the Great Depression. Protectionism didn't insulate the American economy, it isolated and crippled it. Tariffs can be a tool, but they are not a silver bullet. Used recklessly, they risk damaging the very economy they aim to defend. To conclude, Trump's tariff policy is a bold, radical attempt to reshape global trade to America's advantage, just like Nixon's move in 1971 when the US abandoned the gold standard. But unlike the post-war world, the global economy today is multipolar, deeply interconnected, and far less forgiving of unilateral action. The US may still wield immense economic power, but it is no longer untouchable. If the rest of the world chooses to reduce its reliance on the dollar, the consequences could be dramatic. A loss of dollar privilege, higher borrowing costs, weakened geopolitical influence, and a fundamental reshaping of global finance. Tariffs may seem like a quick fix, an assertive way to protect American industries and reduce the trade deficit. But the long-term risks include fracturing alliances, accelerating de-dollarization, and fueling global economic instability. The effects could ripple through supply chains, investment flows, and even monetary policy. The US must ask itself, is it worth risking long-term global leadership, economic stability, and trust for short-term fiscal wins? In a world where power is shifting and alliances are fragile, this gamble may be remembered not for what it solved, but for what it unleashed.